NAR does a great job. Every month they come out with this. I always look forward to it. Not the least of which is its ability to track all of these different sectors, and you can kind of figure out where where the top performers are, where the bottom performers are, and it's not a spoiler to say that that multifamily is doing well again this year. This month. And this is another thing I think that's interesting and a little bit unique about real estate over other is place is so important. And not all multifamily is not a monolith, but if you're buying multifamily properties, there's a difference between a property in Miami and a property in Tallahassee. And some of these, and I just like on page 11 of this report, they have a list of these cities where you can find potentially profitable deals where the rent growth is super high, the vacancy rate is super low, and you see a lot of Miami is up there, but other there's Detroit, Columbus, and Cincinnati. There's some Midwestern places too, and it's really across the board where Omaha is a Great Plains states, Sioux Falls, Chattanooga, Knoxville. There's a lot of smaller cities and smaller locations, and this is just kind of the tip of the iceberg, and we've gone through this before. If you really look at submarkets and place, you can get so granular when you're talking about an individual property and choosing to invest in it. So it's just another repeat of it pays to pay attention and to look closely, because sometimes the opportunities are not where everyone's paying attention, and the market is such that right now you'll find something if you look hard enough.
That's I don't understand their cap rates.
Me neither. It does seem a very rosy.
Well, they're just wrong. You're not buying 8 caps in Columbus.
Yeah.
You're not buying anything above a 5, just about anywhere. Certainly not in Miami, Florida, Tampa, Florida, Fort Lauderdale. You're buying sub 3s right now. So I think that's where I don't, and they got this data from CoStar. CoStar cap rate data cannot be the best. One, it's kind of blended from, they're using a longer time frame. It's also a lot of different asset classes. The CoStar cap rates are always significantly higher than what's going on the ground. Now you can say, oh, maybe you're just overpaying. It's just they're taking information from, a quadplex, a 5-unit deal sells for an 8 cap, and they're not selling for 8 caps. So I don't know where they're getting this data from, but it flies in the face of all information I've seen, and not just anecdotally, but from other reports. I haven't seen. I mean, the average cap rate in the United States right now is 4.5%. They have New York at a 5.5%. 5 in New York City hasn't been a +5 cap market in probably over a decade. So I think that so take the cap rates out. I think the year-over-year rent growth and the vacancy rate is definitely good to look at, and absorption as well. But their cap rate is, because they're trying to with yield. Anyway, so enough on that. That's just my criticism for that particular little piece of data.
Yeah. So, and just as it compares to other sectors of the real estate, it does talk about industrial demand remaining strong. The office market, there's kind of a modest performance, to say the least. It's not doing as well as people were really hoping, and but for retail, the occupancy is actually increasing, and that seems to be recovering a little bit. Hotel market is also recovering, but I think that also has a longer way to go, perhaps, than the office market.
Yeah. And again, just from the anecdotes from this week, the ADRs, average daily rent, still way below where they have been historically. There's a lot of forbearance in the hotel industry. And what I found interesting, I didn't know, a lot of the flags, they have these things called PIPs, which I don't know what it stands for because I'm not a hotel guy, but eventually it's like required CapEx. You gotta put in new drapes and new TVs. Like you gotta update, because they want to have uniformity in their properties. and they did not do PIPs they have suspended PIPs. You don't have to put more money into your hotel. They are going to be restarting those. And so hoteliers are going to have to start spending more money, which some aren't going to want to spend the money or probably don't want to sell. So I think we're going to see some distress situations. So it'll be interesting to see over the next couple of years, I think.
Yeah, I just want to call your attention just really quickly on page 2 of this report. There is a nice chart that looks at the rents, and again, this is based on the CoStar data still. But you can see, and I like this because it has a long time period where they're measuring this in quarters from 2011 to 2021, and you can really see multifamily take off, whereas offices doing modestly. Like I said, it really suffered. Industrial has a very smooth transition, but it is super dramatic how quickly multifamily has grown, and retail seems to have a similar upswing. But you can see at a glance how different the performance is in these places.